cost analysis. Concept of cost. Definition, keep as it is, the study of the behavior of the cost with respect to various factors like output size, scale of operations, prices of inputs, labor, material, and other economic variables is called cost analysis. Simple meaning. It means how cost changes when we produce more or less products, use different materials, or change the size of the factory. Example. If a small factory makes 100 pens, the cost will be 10 per pen. But if the same factory makes 1,000 pens, the cost may become 5 per pen due to bulk production. Key points to remember. 1. Cost analysis equals behavior of cost. 2. Based on output size. 3. Based on scale of operations, small, large factory. 4. Based on prices of inputs. Cost behavior economic variables. Short trick memory word. COP-C cost behavior. O. Output size. Prices of inputs. S. Scale of operation. Final word. Now whenever you hear cost analysis, just remember COPS. The cost, meaning and definition. 1. Simple meaning of cost. Cost equals the total money spent to produce goods or services. The cost of production includes all resources used: land, labor, capital, entrepreneur. Key components of cost: 1. Labor, workers' wages. 2. Land, rent. 3. Capital, machines, tools. 4. Entrepreneur, business owner's efforts. 5. Taxes, government charges. 2. Definitions, keep these as they are. Campbell. Production cost equals money paid to resource owners so they continue supplying resources for production. Gullery and Wallace. Production cost equals all payments made to get land, labor, capital, and management to produce goods. 3. Example to understand cost. A company producing bikes spends money on paying workers, labor cost. Buying land for the factory, land cost. Machines to make bikes, capital cost. Business owner's profit, entrepreneur's cost. Government taxes, tax cost. Total cost of making bikes equal cost. Short trick to remember. L, labor, land. C, capital. E, entrepreneur. Taxes. Final word. LL seat. Now, whenever you see cost, just remember. Types of costs. Simplified explanation. There are different types of costs in business, and each has its own meaning and importance. Let's understand them in a simple way with examples. Number 1. Opportunity cost and actual cost. Opportunity cost. The benefit lost when choosing one option over another. Example. A person quits a $30,000-month job to start a business. The $30,000 is the opportunity cost. Actual cost. The real expenses recorded in accounts like rent, salaries, and raw materials. Example, a company pays $50,000 for rent. This is the actual cost. 2. Business cost and full cost. Business cost, the total expenses to run a business, including salaries, rent, and materials. Full cost, business cost plus opportunity cost plus normal profit. 3. Direct cost and indirect cost. Direct cost, costs directly linked to production, e.g., raw materials, wages for production workers. Indirect cost, costs not directly linked to production, e.g., office rent, manager salaries. 4. Incremental cost and sunk cost, additional costs due to expansion or new products. Example, adding a new machine increases electricity costs. Sunk cost, past costs that cannot be recovered. Example, 1 lakh spent on a failed marketing campaign. 5. Explicit cost and implicit cost. Explicit cost, payments made to outsiders, e.g. wages, rent, raw materials. Implicit cost, the cost of self-owned resources, e.g. an entrepreneur's unpaid salary. Number 6. Historical cost and replacement cost. Historical cost, original price of an asset. Example, a machine bought in 2000 for $50,000. Replacement cost, current price to buy the same asset. Example, the same machine costs $150,000 today. 7. Past cost and future cost. Past cost, already incurred and cannot be changed. Future cost, expected expenses for future planning. 8. Shutdown cost and abandonment cost. Shutdown cost, costs to temporarily close a business, e.g. maintenance during closure. Abandonment cost, costs to permanently close, e.g. selling assets, removing equipment. 9. Real cost and prime cost. Real cost, actual expenses recorded in accounts. Prime cost, costs directly related to production, direct materials, direct wages, direct expenses. Number 10. Urgent cost and postponable cost. Urgent cost must be paid immediately, e.g. wages, electricity bills. Postponable cost can be delayed without immediate impact, e.g. machine maintenance. 11. Escapable cost and unavoidable cost. Escapable cost can be reduced by reducing operations, e.g. closing a branch. Unavoidable cost. Fixed costs that do not change with production, e.g. rent. 12. Out-of-pocket cost and book cost. Out-of-pocket cost, actual cash payments, e.g. salaries, rent. Book cost, non-cash expenses recorded in accounts, e.g. depreciation. 13. Fixed cost and variable cost. Does not change with production, e.g. rent, salaries. Variable cost changes with production, e.g. raw materials, labor, wages. 14. Total, average, and marginal cost. Total cost, TC, sum of all costs to produce goods, services. Average cost, AC, total cost divided by units produced, TC per Q. Marginal cost, MC, cost to produce one extra unit. 15. Short-run cost and long-run cost. Short-run cost, some factors like machines are fixed and only variable costs change. Long-run cost, all costs can change and firms can expand or contract production. 16. Private cost and social cost. Private cost, costs paid by businesses for production, e.g. raw materials, labor. Social cost, costs society bears due to business activities, e.g. pollution. 17. Accounting cost and economic cost. Accounting cost, recorded in financial books, e.g. rent, salaries. Economic cost, accounting cost plus opportunity cost. Short trick to remember, DIPs form cash. D, direct and indirect cost. I, incremental and sunk cost. P, private and social cost, short-run and long-run cost. F, fixed and variable cost. O, opportunity and actual cost. R, real and prime cost. M, marginal, average, and total cost. C, business and full cost. A, accounting and economic cost. Shutdown and abandonment cost. Historical and replacement cost. By remembering DIPs form cash, you can recall all major types of costs easily. Difference between implicit cost and explicit cost. 1. Meaning implicit cost, cost of using own resources like personal capital, inventory. Explicit cost, cost of paying for resources like rent, wages. Nomenclature, other names. Implicit cost, also called imputed cost, opportunity cost. Explicit cost, also called out-of-pocket cost. Determining costs. Implicit cost, hard to measure as there are no direct records. Explicit cost, easily measurable since payments are recorded. 4. Calculation of profit. Implicit cost, used for calculating economic profit, not accounting profit. Explicit cost, used for calculating both economic and accounting profit. 5. Cash flow. Implicit cost, no direct cash payment. Explicit cost, direct cash payment involved. #6, example, implicit person quits a 1,000-month job to start a business. The lost salary is an implicit cost. Explicit cost, rent, wages, interest, salaries, fuel, insurance, etc. Trick to remember, implicit cost, own resources. N, nomenclature, opportunity cost. O, outflow of cash, no for implicit, yes for explicit. C, calculation of profit, economic for implicit, both for explicit. E, easy or hard to measure, hard for implicit, easy for explicit. C, cost examples, salary loss for implicit, rent and wages for explicit. Understandable word. Difference between fixed cost and variable cost. Meaning, fixed cost does not change with production, same cost even if production is 0. Variable cost changes as production increases or decreases. 2. Examples. Fixed cost, rent, salary, insurance, tax, depreciation, paid even if production stops. Variable cost, raw materials, wages, sales commission, packing costs, increase when production increases. Trick to remember, F, fixed cost, E, examples, rent, salary, V, variable cost changes. A, adjusts without raw materials. Understandable word, faha. Difference between average cost and marginal cost, meaning average cost, AC, total cost divided by total units per unit, marginal cost, MC, extra cost to produce one more unit. 2. Computation. AC equals total cost per total units. MC equals cost of x plus 1th unit, cost of x units. 3. Shape of curve. AC curve, U-shaped, decreases then increases. MC curve, concave then convex, first decreases, then rises sharply. 4. Cost segregation. AC can be divided into fixed cost and variable cost. MC cannot be divided into parts. 5. Benchmark for decision making. AC used when goal is minimizing cost. MC used when goal is maximizing profit. Trick to remember. ACMC AM average cost, total cost per total units. M marginal cost, extra cost for one more unit. Understandable word. Classifying cost concepts. 1. Traceability. Can cost be directly linked to a product service? Direct costs, easily traced, e.g. raw materials, labor. Indirect costs, not easily traced, e.g. rent, electricity. 2. Separability. Can cost be separated into specific products? Separate costs, assigned to one product service. Common costs shared by multiple products, e.g. factory rent. Joint costs. Cost incurred for producing multiple products from the same process, e.g. crude oil refining gives petrol and diesel. Byproduct costs, cost related to byproducts, low-value products from production. 3. Computation. How is cost calculated? Historical past costs, already incurred in past. Replacement costs, cost to replace an asset today. 4. Variability. Does cost change with production? Variable costs, changes with output, e.g. raw material, wages. Semi-variable costs, partly fixed, partly variable, e.g. electricity bill with fixed usage charge. Fixed costs, does not change with output, e.g. rent, salaries. 5. Controllability. Can cost be controlled by management? Controllable costs can be managed reduced, e.g. overtime wages. Uncontrollable costs cannot be changed by management, e.g. taxes, depreciation. 6. Economic concept. Cost in economic decision-making. Opportunity cost, next best alternative, foregone, e.g. quitting a job to start a business. Marginal cost, cost of producing one more unit. Incremental cost, additional cost when expanding operations. Differential cost, cost difference between two alternatives. Escapability. Can the cost be avoided? Escapable cost can be eliminated if operations stop, e.g. raw materials. Sunk cost, already spent, cannot be recovered, e.g. research expenses, advertising. 8. Liquidity, cash position, relates to cash availability and how quickly costs can be covered. Trick to remember, TSVCEEL. T. Traceability, direct, indirect. S. Separability, separate, common, joint, byproduct. V. Variability, variable, semi-variable, fixed. Computation and controllability, historical replacement, controllable, uncontrollable. E. Economic concept, opportunity, marginal, incremental, differential. E. Escapability, sunk. L. Liquidity, cash position. Understandable word, TSVCL. Determinants of cost. 1. Law of returns operating. Cost increases when diminishing returns operate. More input, less output. Cost decreases when increasing returns operate. More input, more output. Example, if a factory hires too many workers in a small space, productivity falls and cost increases. 2. Size of the plant. Bigger plant, high fixed cost, low variable cost. Smaller plant, lower fixed cost, the higher variable cost. Example, a large factory has high rent but lower per unit production cost. 3. Period, time frame. Short run, cost rises faster due to limited resources. Long run, cost rises slower as adjustments are possible. Example, a company may rent extra machines temporarily, high cost, but buy new ones later, lower long-term cost. 4. Capacity utilization. Higher capacity usage, lower fixed cost per unit. Lower capacity usage, higher fixed cost per unit. Example, running a factory at full capacity reduces cost per unit compared to partial operation. 5. Prices of factors of production. Cost depends on the price of inputs, land, labor, capital. The more important an input, the bigger its impact on cost. Example, if wages increase, production cost also increases. 6. Technology. Better technology reduces cost. Example, automated machinery reduces labor costs. 7. Efficiency in input use. Efficient input usage reduces waste and cost. Example, using quality raw materials reduces defect rates and rework costs. 8. Lot size of product. Bigger lot size, lower per unit cost. Smaller lot size, higher per unit cost. Example, buying raw materials in bulk reduces cost per unit. 9. Stability of output. Stable production, lower cost. Irregular production, higher cost due to inefficiency. Example, a factory that runs continuously has lower cost than one that stops frequently. Trick to remember: S, size of plant. L, law of returns operating. P, period, time frame. Prices of factors of production. Technology. E, efficiency in input use. L, lot size. Output stability. Capacity utilization. Understandable word, SLPP, tell us. Cost function, simple explanation. The cost function shows the relationship between cost and factors affecting cost. It is a mathematical formula that explains how cost changes when factors like output, plant size, time, and input prices change. Cost C depends on O, output level, more production equals more cost. Est, size of the plant, bigger plants, higher fixed cost, lower variable cost. T, time, short-term costs rise fast, long-term costs rise slow. P, price of production factors, raw material, labor cost C, F, O, S, T, P. This means cost C is a function of output, plant size, time, and prices of inputs. Example, a small bakery has low fixed costs, rent, electricity, but high variable costs, flour, sugar, labor. If the bakery expands, fixed costs increase, bigger rent, machinery, but variable costs reduce per unit, buying flour in bulk. Trick to remember: OSTP, O, output, S, size of plant, T, P, price of inputs, understandable word. Cost curve, simple explanation. A cost curve is a graphical representation of how costs change when production changes. Firms use cost curves to find the best level of production that minimizes costs and maximizes profits. Different cost curves are connected, such as total cost, TC, average cost, AC, and marginal cost, MC. Types of cost curves and their behavior. 1. Marginal cost, MC curve, first decreases, then increases. Why? Initially, efficiency improves, but later, costs rise due to diminishing returns. Cuts the AVC and ATC curves at their lowest points. 2. Average variable cost, AVC curve, first goes down, then rises, but not as sharply as MC. Why? More production spreads variable costs over many units, but later inefficiencies increase costs. 3. Average fixed cost, AFC, curve always declines as production increases. Why? Fixed costs like rent are spread over more units, reducing per unit cost. 4. Average total cost, ATC curve, first declines, then rises due to increasing marginal costs. Why? Initially, fixed and variable costs are spread, but later inefficiencies increase total cost. Key takeaways. MC curve cuts AVC and ATC at their lowest points. AFC always falls as production increases. ATC and AV fall first, then rise due to diminishing returns. Trick to remember: MATM, marginal cost, MCA, average variable cost, AVC, A, average fixed cost, total cost, ATC. Understandable word, mate. Cost analysis is decision-making. Cost helps managers make smart business decisions by understanding costs and their impact on profits. 1. Product costing and pricing decisions. Decides product prices using different pricing strategies. Example, if customers are price sensitive, the company reduces unit costs and spreads fixed costs over a large output, penetration pricing. Helps reduce costs to maintain profits. Example, if wages increase or new government taxes apply, managers must control costs to keep business profitable. Profit planning. Profit planning depends on cost analysis. Example, a company creates a projected income statement and decides the best activity level based on cost, volume, and profit. Capital investment decisions compares costs and benefits before investing in assets. Example, a company analyzes long-term financial costs and benefits before buying new machinery. 5. Marketing decisions controls marketing costs by comparing them to sales revenue. Example, a company analyzes the profit-loss statement to see which marketing activities generate the most revenue. Key takeaways. Cost analysis helps in cost control, profit planning, investment, and marketing decisions, reduces risks, and improves financial performance. Trick to remember, PCCIM, pronounced PICIM. P, product costing and pricing. C, cost management. C, capital investment decisions. I, investment decisions. M, marketing decisions. Understandable word, PICIM. 1. What is cost-output relationship? It explains how costs change when the output production increases or decreases. Helps managers in cost control, profit prediction, pricing, and promotions. Cost function equals relationship between cost and its influencing factors, like production method and input prices. Types of cost functions. Short-run cost function. Fixed capacity. Company cannot increase factory size but can increase production by using existing resources more efficiently. Example, a bakery can't expand its shop but can increase production by working extra shifts. Long-run cost function. Flexible capacity. Company can expand or reduce production size based on market demand. Example, a car manufacturer can build a new factory if demand increases or shut down a plant if sales drop. Key takeaways. Short-run, fixed capacity, only better use of resources. Long-run, capacity can increase or decrease based on demand. Managers use cost-output analysis for profit, pricing, and cost control. Trick to remember, SL short-long, S short-run small adjustments, L long-run large changes. Understandable word, short-run cost-output relationship. What is short-run cost-output relationship? In the short run, a company has a fixed production capacity. Plant size cannot change. The only way to increase production is by using existing resources more efficiently. The cost of production changes as output increases, which is analyzed through 1. Marginal cost, MC, and output. 2. Average cost, AC, and output. 3. Total cost, TC, and output. Understanding cost-output relationship. 1. Marginal cost, MC, and output. MC equals additional cost of producing one extra unit. Initially decreases, but later increases due to inefficiencies, law of diminishing returns. Example, a factory making 10 shirts spends $1,000. If making the 11th shirt costs $50 more, MC equals 50. 2. Average cost, AC, and output. AC equals total cost divided by total output. Initially decreases as fixed costs spread over more units, but later increases as marginal cost rises. Example, if a company produces 10 units at 1,000, AC equals 100 per unit. But if 20 units cost 1,500, AC equals 75 per unit. Cost per unit reduces. 3. Total cost, TC, and output. TC equals fixed cost, variable cost. Fixed cost, FC, remains constant, while variable cost, VC, increases as output rises. Example, a bakery's monthly rent, fixed cost is $10,000. Flour, sugar, and wages, variable costs, increase as more cakes are baked. Key takeaways. MC, extra cost for one more unit, first decreases, then increases. AC, total cost per unit, falls initially, then rises. TC, sum of fixed and variable costs, always increases with production. Short run, fixed plant size, cost varies based on output. Trick to remember. M, marginal cost. A, average cost. T, total cost. Understandable word, mat, like a floor mat, which supports cost understanding. 1. What is total cost in the short run? In the short run, a business has some fixed costs and some variable costs. Total cost, TC, equals total fixed cost, TFC, total variable cost, TVC. 2. Types of costs in the short run. 1. Total fixed cost, TFC, fixed expenses. TFC stays the same no matter how much is produced. Even if the company stops production, these costs still exist. Examples: rent, salaries of permanent staff, insurance, property tax, depreciation. Graph, TFC is a straight horizontal line constant at all output levels. Formula, TFC equals fixed productive service quantity factor price. Example, a factory pays 20,000 rent every month. Even if it produces 0 or 1,000 units, the rent remains 20,000. 2. Total variable cost, TVC. Changing expenses. TVC increases as production increases and decreases if production falls. If output equals 0, TVC equals 0, no production, no variable cost. Examples, raw materials, electricity, wages of temporary workers, water bills. Graph, TVC curve starts from 0 and increases with output. Formula, TVC equals variable productive service quantity factor price. Example, a bakery needs flour and sugar to make cakes. If no cakes are baked, flour and sugar costs are shunned. If more cakes are made, costs increase. 3. Total cost, TC, overall expenses. TC is the sum of fixed and variable costs. Even when output equals 0, TC equals TFC, because fixed costs still exist. Graph, TC curve is the sum of TFC and TVC curves. Formula, TC equals TFC plus TVC. Example, if rent TFC is 20,000 and raw material TVC cost is 50,000, then TC equals 20,000 plus 50,000, 70,000. Key takeaways. TFC fixed cost doesn't change with output. TVC variable cost changes with output. TC, total expenses, TFC, TVC. TFC curve equals straight horizontal line. TVC curve starts from 0, increases with output. TC curve equals addition of TFC and TVC curves. Trick to remember. FVT. F, fixed cost, TFC, V, variable, T, total cost, TC. Understandable word, FVT, favorite without vowels. Short-run, average cost curves. 1. What are short-run average costs? In the short run, average costs are important because the firm needs to understand how much it costs to produce 1 unit of output. The average cost AC consists of 3 parts. 1. Average fixed cost, AFC. 2. Average variable cost, AVC. 3. Average total cost, ATC. 2 key components of average costs. 1. Average fixed cost, AFC. Formula, AFC equals TFC wider cute. What is it? It shows the cost per unit of output for fixed costs, which do not change with output. As output increases, AFC decreases because the same fixed costs are divided by a larger number of units. Shape. The AFC curve is downward sloping, meaning it decreases as output increases. Example, if the rent TFC is 100 and the firm produces 10 units, then AFC equals 100 but 10 equals 10. If the output increases to 20 units, AFC equals 100 but 20 equals 5. Ashker 2. Average variable cost, AVC. Formula, AVC equals TVCQ. What is it? It shows the cost per unit for the variable costs, which change with output. Initially, AVC decreases with more output due to efficiency, but eventually it increases because of the law of diminishing returns. Shape. The AVC curve is U-shaped. It initially falls and then rises. Example, if the firm spends 50 on raw materials TVC and produces 10 units, AVC equals 50 but 10 equals 5. If the output increases to 20 units, AVC equals 100 but 20 equals 5, but at a higher level of output, AVC might increase. 3. Average total cost, ATC. Formula, ATC equals TFC plus TVCQ, or ATC's AFC plus AVC. What is it? It is the total cost per unit produced. Initially, ATC is high due to high AFC and AVC at low output levels. But as production increases, ATC decreases because both AFC and AVC fall. Shape. The ATC curve is U-shaped, reflecting the combination of AFC and AVC. Example, if TFC equals 100, TVC equals 100, and output equals 10 units, then ATC equals 100, but 10 equals 20. At higher output, ATC decreases due to more efficient production. Why is the average cost curve U-shaped? The U-shape of the average cost curve can be explained by 2 factors. 1. Interaction of AFC and AVC. AFC falls as output increases, while AVC initially falls and then rises. When AFC falls more than AVC rises, the ATC decreases. But beyond a certain point, AVC increases faster than AFC falls, leading to an increase in ATC. 2. Law of variable proportions. Initially, Combining more variable factors, like labor, with fixed factors, like machinery, increases output efficiently. This causes decreasing average cost. But after a certain point, variable factors become less efficient compared to fixed factors, causing the average cost to rise. Any 4 key takeaways. AFC decreases as output increases. AVC initially falls and then rises due to diminishing returns. ATC is U-shaped because it includes both AFC and AVC. Optimal production is at the lowest point of the ATC curve, point A. Beyond this point, average cost rises due to inefficiency. 5. Trick to remember. Fe, fixed cost. Average cost, ATC. Variable cost, AD. Understandable word, like favorite without vowels. However, short-run marginal cost, SMC. 1. What is marginal cost, MC? Marginal cost, MC, is the extra cost incurred when producing one additional unit of output. Formula, MC equals change in total cost, TC, change in output, Q. MC equal TCN plus 1, TCN. Since fixed costs, TFC, do not change, marginal cost is based only on total variable cost, TVC, or total cost, TC. Shape, marginal cost curve is U-shaped, falls first, then rises. 2. Why is the marginal cost curve U-shaped? There are 2 stages. Stage 1, MC falls initially. At lower production levels, increasing returns occur because resources, labor, machinery are used efficiently. Cost per additional unit decreases, MC falls. Stage 2, MC rises after minimum point. Due to the law of diminishing returns, adding more inputs makes production less efficient. Cost per additional unit increases, MC rises. This creates a U-shaped MC curve. MC is the extra cost of producing one more unit. MC curve is U-shaped due to increasing and diminishing returns. Initially, MC falls, reaches a minimum, then rises. MC is important for deciding optimal output levels. Trick to remember, FMU. Falls initially, minimum point. U-shaped curve. Understandable word FMU, like from you without vowels. Interrelationship between average cost AC and marginal cost MC. 1. What is the relationship between AC and MC? Average cost, AC equals total cost, total output. Marginal cost, MC equals change in total cost, change in output. The price theory depends on this relationship because firms use MC and AC to set prices and decide production levels. Key relationships between AC and MC. When MC, AC falls. If producing one more unit costs less than the current average, the average cost decreases. Example, if current AC equals 100 and the next unit costs 80 MC, then AC will reduce. When MC, AC rises. If producing one more unit costs more than the current average, the average cost increases. Example, if AC equals 100 and MC equals 120, then AC will increase. When MC equals AC, AC is at minimum. The MC curve always cuts the AC curve at its lowest point. This means when AC stops decreasing and starts increasing, MC is equal to AC. 3. Why are AC and MC curves U-shaped? Both AC and MC curves are U-shaped due to the law of variable proportions. At low production, efficiency increases, costs decrease. At high production, inefficiencies arise, costs increase. MC always changes before AC because marginal changes affect the average later. MCAC, AC falls. MCAC, AC rises. MC equals AC at AC's minimum point. MC curve cuts AC curve at the lowest point. Both AC and MC are U-shaped. Trick to remember, firm. Falls when MC intersects at AC's minimum, rises when MC, AC. Marginal cost fixes. Understandable word firm, like a business firm. Cost-output relationship. What is the long run? The long run is a period where all production factors, land, labor, capital, can be changed. Unlike the short run, there are no fixed costs. Everything is variable. The firm can change plant size, technology, and input combinations to minimize cost. Example, a company planning to expand its factory doesn't just add more workers, short run, it builds a bigger factory, long run. How is the long run related to the short run? The long run cost curve is formed by combining many short run cost curves. A firm chooses a short run cost curve depending on the plant size and output level. The firm can switch between short run cost curves as it expands or contracts production. Example, a bakery starts with one oven, short run. As demand grows, it shifts to a bigger setup with more ovens, long run. 3. How does a firm minimize cost in the long run? The firm chooses the best combination of plant size, factory equipment, raw materials, quality, quantity, labor skills, experienced trained workers, technology, automation, AI, etc. Goal, maximum output at lowest cost. 4 key takeaways. Long run equals all costs are variable, no fixed cost. Combination of many short run cost curves. Firm chooses the most cost-efficient production method. Best input combination equals lowest cost and highest output. Have 5 trick to remember. Vote. V, variable cost only, no fixed cost. O, output level determines cost. T, technology and inputs change. E, efficient production method is chosen. Understandable word, vote, like a firm voting for the best cost method. Long run total cost, LRTC. What is long run total cost, LRTC? In the short run, cost has 2 parts. Fixed cost, FC, does not change with output. Variable cost, VC, changes with output. In the long run, all costs are variable, no fixed cost. The firm can adjust plant size and switch between short-run cost curves, SRTC, to minimize cost. Example, a small shop expands into a supermarket. In the short run, rent is a fixed cost, but in the long run, they can move to a cheaper location. 2. Short-run cost curves and plant size. SRTC1, SRTC2, SRTC3 represent different plant sizes. The firm picks a plant that offers lowest cost for a given output level. If demand grows, the firm moves to a larger plant with a new short-run cost curve. Example, small bakery, SRTC1, cheapest for low production. Medium bakery, SRTC2, best if orders increase. Large bakery, SRTC3, required for mass production. What is the long-run cost curve, LRTC? LRTC is the combination of multiple SRTC curves. It is flatter than SRTC curves because firms can always choose the lowest cost option at each output level. LRTC is called the envelope curve because it touches all SRTC curves from below. Example, a company can shift production between factories to always stay on the cheapest cost curve. Key takeaways. Short run has fixed and variable costs. Long run has only variable costs. Firm chooses the cheapest short run cost curve. LRTC equals smooth curve connecting multiple SRTC curves. LRTC is flatter because firms can adjust inputs and plant size. Flex, F, flatter curve, LRTC is less steep than SRTC. L, lowest cost option always chosen. E, envelope curve, LRTC touches SRTC from below. Firms extra flexibility, firms adjust plant size and inputs. Understandable words. Firms have flexibility in long-run cost decisions. Long-run total cost, LRTC, simplified explanation. What is long-run total cost, LRTC? In the short run, costs are divided into fixed cost, FC, does not change with output, variable cost, VC, changes with output. In the long run, all costs are variable. Firms can change plant size, machinery, and labor. Example, a small restaurant expands into a franchise. Rent and equipment, which were fixed in the short run, can be changed in the long run. Short-run cost curves and plant size. SRTC1, SRTC2, SRTC3 represent different plant sizes. Firms pick a plant that offers the lowest cost for a given output. If demand grows, the firm moves to a larger plant with a new short-run cost curve. Example, small SRTC1, cheap for small orders. Medium factory SRTC2, efficient for medium production. Large factory SRTC3, best for mass production. Understanding the long-run cost curve, LRTC. LRTC is formed by combining multiple SRTC curves. It is flatter than SRTC curves. Firms can always choose the lowest cost option. LRTC is called the envelope curve because it touches all SRTC curves from below. A car company shifts production between factories to always produce at the lowest cost. 4. Key takeaways. Short run has fixed and variable costs. Long run has only variable costs. Firm chooses the cheapest short run cost curve. LRTC equals a smooth curve connecting multiple SRTC curves. LRTC is flatter because firms can adjust inputs and plant size. Trick to remember: flex. Flatter curve, LRTC is less steep than SRTC. L, lowest cost option always chosen. E, envelope curve, LRTC touches SRTC from below. X, extra flexibility, firms adjust plant size and inputs down to word. Flex, firms have flexibility in long-run cost decisions. Stack. Explain simply. 1. What is LRAC? The long-run average cost. Curve shows the lowest cost at which a firm can produce different output levels when all factors of production are variable, adjustable. 2. Why is LRAC important? It helps firms choose the best plant size for different production levels. It helps in cost minimization in the long run. It is formed by combining multiple short-run average cost curves. Names of LRAC curve. 1. Envelope curve. It surrounds all the SRAC curves from below. 2. Planning curve. Firms use it to decide the best plant size for different production levels. LRAC and SRAC relationship. LRAC is formed by the lowest cost points of multiple SRAC curves. It is always flatter than SRAC because firms have more flexibility in the long run. LRAC-C never cuts SRAC from below because that would mean SRAC is cheaper, which is impossible. Why is the LRAC curve U-shaped? 1. Economies of scale. Cost decreases as output increases. Labor specialization. More skilled workers, faster work. Technical economies. Better machinery and technology. Indivisibility economies. Full utilization of resources like management and equipment. 2. Diseconomies of scale. Cost increases after a certain point. Managerial issues. Difficult to manage a very large organization. Coordination problems, miscommunication and inefficiency. Increased overhead costs, more paperwork, meetings, travel expenses. Short trick to remember: EPIC DU. E, envelope curve. P, planning curve. I, indivisibility economies. C, coordination issues. D, diseconomies of scale. U, U-shaped curve. This trick will help you recall the key points during exams. Long-run marginal cost, LRMC. Simple explanation. 1. What is long-run marginal cost, LRMC? LRMC refers to the additional cost incurred when producing one extra unit of output in the long run. It is derived from short-run marginal cost, SRMC, curves. 2. How is LRMC derived? Each short-run average cost track curve has a corresponding short-run marginal cost, SRMC, curve. For every output level, the firm selects a point on an SRAC curve, and the matching point is also taken from the SRMC curve. The locus collection of these points forms the long-run marginal cost, LRMC, curve. 3. Example for better understanding. Imagine a car factory. If the factory produces 100 cars and wants to increase to 101 cars, the extra cost incurred is the marginal cost. In the short run, there is one SRMC curve for each factory size. In the long run, the firm can choose the most cost-effective factory size for any output level, forming the LRMC curve. U-shape of long-run average cost curve. Why is the LRAC curve U-shaped? Phase 1, decreasing cost. When a company expands, cost per unit decreases due to economies of scale, cost-saving benefits of large production. Phase 2, constant cost. At a certain level, costs remain stable, constant returns to scale. Phase 3, increasing cost. Beyond a limit, costs increase due to diseconomies of scale, complexity, inefficiency. This results in a U-shaped curve. Key reasons for U-shape. 1. Economies of scale, cost goes down. Labor specialization, workers become experts in specific tasks. Technical economies, advanced machinery improves efficiency. Bulk purchasing, buying raw materials in bulk reduces cost. 2. Diseconomies of scale, cost goes up. Managerial inefficiency, too many employees, difficult coordination. Communication issues, large firms face delays in decision-making. increased administrative costs, more paperwork, travel, and management expenses. Short trick to remember: LED, Aber specialization, economies of scale, DICE economies of scale. Aber division lowers cost. Economies of scale bring efficiency. ICE economies of scale increase cost. This helps you recall the concept of LRAC's U-shape easily. Interrelationship between short-run and long-run cost curves. 1. Understanding the difference. Short-run costs. Some costs are fixed, e.g. rent, machinery, and cannot be changed immediately. Long-run costs. All costs become variable. Firms can change factory size, buy new machines, etc. 2. How are they related? Long-run cost curves are built from short-run cost curves. Every decision in the long run comes from different short-run situations. Example: a company has a small factory in the short run, fixed cost. As demand grows, it can expand long run, making costs variable. This transition shows the connection between short-run and long-run cost curves. 3. Graphical representation, figure 7.9. The long-run average cost, LRAC, curve is made up of many short-run average cost, SRAC curves. The firm chooses the lowest cost option for each production level, forming the LRAC curve. Short trick to remember: F fixed cost, V variable cost, L long run, fixed in the short run, V variable in the long run. LRAC depends on multiple SRACs. This will help you recall the concept quickly. Relationship between cost and production function. 1. What is a production function? It shows how inputs, labor, capital, raw materials, etc. are used to produce output. Formula: Q equals F in I2 in Q output, in I2 in inputs used. 2. What is a cost function? It shows the cost of producing output based on the price of inputs. Formula: QC equals P1 the in P2 I2 Pn cost of producing output Q P1 P2. Prices of inputs, I1, I2, quantity of inputs. How are they related? More inputs, more cost. When input prices stay the same, higher production means higher total cost. Returns to scale matters. Increasing returns to scale, output increases faster than cost. Decreasing returns to scale, output increases slower than cost. 4. Graphical representation, figure 4.13. S-shaped cost curve. First, cost rises slowly due to economies of scale. Then cost rises faster due to diseconomies of scale. Short trick to remember: PIC, reduction function, I inputs, C host function. Production function decides output. I inputs affect cost. C host function shows the relation between inputs and costs. This will help you recall the concept quickly. Cost reduction and cost control. 1. What is cost reduction? It means permanently lowering costs without reducing product quality. Achieved by lowering cost per unit, increasing productivity. Steps for cost reduction: reducing waste, improving efficiency, using cheaper materials without compromising quality, finding better production methods. Example: a company switches to automated machines, reducing labor costs and increasing output. What is cost control? It means keeping costs within a budget by comparing actual costs with planned costs. It does not always mean cost reduction, but ensures money is used efficiently. Features of cost control. 1. Responsibility centers. Assign cost management duties to teams. 2. Setting budgets. Define cost limits based on goals. 3. Monitoring costs. Compare actual spending versus planned spending. 4. Corrective actions. Fix cost overruns. 5. Motivating employees. Encourage cost-saving behavior. 6. Regular follow-ups. Ensure cost-saving strategies are working. Example: a company sets a 10 lakh budget for marketing. If spending exceeds, corrective actions like renegotiating vendor contracts are taken. Key difference: cost reduction versus cost control. Aspect: cost reduction. Cost control. Goal: reduce cost permanently, keep cost within limits. Focus: efficiency, waste reduction, budget adherence. Scope: internal factors, process improvement, both internal and external factors. Outcome: lower cost per unit, no unnecessary overspending. Hack short trick to remember: cost reduction, utilization of budget, track and correct. See, cost reduction lowers expenses. Utilization ensures resources are used wisely. Track and correct variances to control costs. This will help you recall the concept quickly. Cost reduction. There are many ways to reduce costs in a business. Here are the 10 important techniques in simple terms. 1. Just-in-time JIT system. Make and buy only when needed. Avoid keeping too much inventory to reduce storage costs. Example: a car company orders tires only when assembling cars instead of storing them in bulk. 2. Target costing. Plan product cost before making it. Estimate a market price and design the product to match that cost while ensuring profit. Example: if customers can pay $500 for a product, the company designs it so production cost stays below $400. 3. Activity-based management (ABM). Identify and remove useless activities. Focus on only those processes that add value to the product. Example: a factory removes an unnecessary approval step that was slowing production. 4. Lifecycle costing. Check costs over the product's entire life, not just production, but also design, marketing, and after-sales service. Example: a mobile phone company considers software updates and repair costs while setting the price. 5. Kaizen costing. Continuous small improvements, big savings. Instead of big investments, businesses focus on making small cost-saving changes daily. A factory saves money by training workers to reduce material wastage. 6. Business process reengineering, BPR. Redesign business processes completely. Find new, efficient ways to do tasks. Example: a bank moves from paper-based applications to online forms to reduce processing costs. Total quality management. Make quality one's responsibility. Every department works towards improving quality and reducing defects. Example: a phone company ensures each department checks quality, reducing defects and refunds. 8. Value chain analysis. Optimize every step from raw material to final product. Ensure every process adds value and reduces unnecessary costs. A clothing brand finds a cheaper but high-quality fabric supplier. 9. Benchmarking. Learn from the best. Compare with the most successful companies and improve processes. Example: a fast food chain studies McDonald's speed and efficiency to improve its service. 10. Management audits. Find and fix inefficiencies. Internal checks help identify waste and suggest corrective actions. Example: a company audit finds that energy costs are too high, so they switch to LED lights to save money. Short trick to remember: JUMP KTVB, USEFL costing, management audit, process reengineering, Kaizen QM, value chain, benchmarking, and management audit, work improvement. This easy trick will help you recall cost reduction techniques quickly. Techniques of cost control. Cost control helps businesses keep expenses within limits by monitoring and adjusting costs. Here are the 10 important techniques in simple terms. 1. Cost change control system. A system to track cost changes. It helps in monitoring and approving any changes to the planned budget. Example: if a construction project needs extra material, the request must be approved before spending. 2. Performance measurement analysis. Check performance and take action. Uses data to compare planned costs versus actual costs. Example: if a company expected $50,000 for marketing, but spent $70,000, this analysis helps find why. Planned value, PV. How much should be spent till now? It is the budgeted cost for the work that was planned up to a given time. Example: a builder planned to spend 5 lakh by March, but the actual spending is different. 4. Earned value, EV. How much work is done in money terms. Shows the budgeted cost for the completed work. Example: if a bridge project is 50% done and the budget is 1 crore, EV equals 50 lakh. 5. Actual cost, AC. How much money was actually spent. The real cost of work completed. Example: if 60 lakh is spent instead of 50 lakh on a project, it shows a cost difference. 6. Estimate to complete, ETC, and estimate at completion, EAC, predicting future costs, helps estimate the remaining cost to complete the project. Example, if 40 lakh is left in a 1 crore budget, ETC helps estimate whether it's enough. 7. Cost variance, CV. Did we overspend or save? Difference between budgeted cost and actual cost. Formula, CV equals EVAC. Example, if EV equals 50 lakh and AC equals 60 lakh, CV equals minus 10 lakh, cost overrun. 8. Schedule variance, SV. Are we ahead or behind schedule? Difference between planned work and actual completed work. Formula, SV equals EV, PV. Example, if EV 40 lakh but PV equals 50 lakh, work is behind schedule by 10 lakh. 9. Cost Performance Index, CPI. Efficiency of cost usage. If CPI 1, cost is higher than planned. If CPI 1, cost is lower than planned. Formula, CPI equals EVAC. Example, if EV equals 60 lakh and AC 50 lakh, CPI equal 1.2, good cost management. 10. Cumulative CPI and Schedule Performance Index. CPI helps predict total cost at completion. SPI shows if the project is moving as per schedule. Formula, SPI EVPV. If EV equals 40 lakh and PV equals 50 lakh, SPI equals 0.8. Project is behind schedule. Short trick to remember. CV control, performance analysis, earned value, actual cost, cost variance, estimate to complete, cost performance index, variance, CVSVPI, SPI. This easy trick will help you recall cost control techniques quickly. Difference between cost control and cost reduction. Cost control and cost reduction are two techniques used to manage expenses, but they have key differences. 1. Definition. Cost control. Managing costs by setting limits and ensuring they don't exceed planned expenses. Cost reduction. Finding ways to permanently lower costs without affecting quality. Example. A factory sets a budget of 5 lakh for materials. Cost control. If they later find a cheaper supplier without reducing quality, it's cost reduction. 2. Effort versus achievement. Cost control. A process to control costs before spending. Cost reduction, actually reducing costs after analysis. Example, tracking daily office expenses is cost control. Switching to LED bulbs to save electricity is cost reduction. 3. Standards versus improvement. Cost control, tries to maintain set cost targets. Cost reduction, challenges and improves standards. Example, a hotel keeping laundry costs within budget is cost control. Finding a new washing method that reduces detergent usage is cost reduction. 4. Approach. Cost control, conservative and preventive, avoiding overspending. Cost reduction, dynamic and continuous, always looking for better ways. Example, a company limiting travel expenses is cost control. Using video conferencing instead of travel is cost reduction. 5. Type of function. Cost control, preventive, stops costs from exceeding limits. Cost reduction, finds unnecessary costs and removes them. Example, a company checking raw material usage is cost control. Finding a way to use less raw material without reducing output is cost reduction. 6. Timing of action. Cost control happens before costs are incurred. Cost reduction happens after costs are incurred by finding new ways to save. Example, planning a project within 10 lakh is cost control. Finding a cheaper way to complete the project for 8 lakh is cost reduction. 7. Scope. Applies only to standard items with fixed budgets. Cost reduction applies to every business activity. Example, setting a fixed salary budget is cost control. Automating a process to reduce labor costs is cost reduction. 8. Management approach. Cost control focuses on rules and guidelines. Cost reduction encourages innovation and analysis. Example, a restaurant setting a budget for ingredients is cost control. Finding a new supplier who offers discounts is cost reduction. Short trick to remember. Control, standards, tracking, preventive, future cost, cope, management. This simple trick helps you recall the key differences between cost control and cost reduction. Revenue analysis. 1. Meaning of revenue. Revenue is the money a business earns from selling its products or services. It is directly related to demand. Higher demand equals higher revenue. Formula, revenue equals price per unit times quantity sold. Example, if a company sells 1,000 mobile phones at 10,000 each, its revenue equals 1 crore. 2. Revenue in different contexts. For businesses, revenue is the sale proceeds, total income before expenses. For government, revenue comes from taxes, fines, grants, and sales of assets, e.g., mineral rights. 3. Definition by Dooley. The revenue of a firm is its sale receipts or money receipts from the sale of a product. Short trick to remember, RSG revenue, sales, government, formula. This simple trick helps you recall key concepts of revenue analysis. Concepts of revenue. Revenue has 3 main types. 1. Total revenue, TR, the total money earned from selling all units of a product. Formula, TR equals price as quantity. Example, if a company sells 1,000 laptops at 50,000 each, then TR equals 50,000 of 1,000 equals 5 crore. 2. Average revenue, AR, revenue earned per unit of product sold. Formula, AR equals TR quantity. Example, if TR equals 5 crore and 1,000 laptops are sold, then AR equals 5,000 equals 50,000, which is the price of one laptop. 3. Marginal revenue, MR, extra revenue earned by selling one more unit. Formula, MR equals change in TR, change in quantity. Example, if TR increases from 5 crore to 5.5 crore by selling one extra laptop, then MR equals 5.55 crore marchedi, 1 equals 50,000. Short trick to remember, TAM, T total revenue, M marginal revenue. This will help you quickly recall the 3 types of revenue. Concepts of revenue. Revenue is the income a business earns from selling goods or services. It has 3 main types. 1. Total revenue, TR, the total money a company earns from sales. Formula, TR equals price quantity. Example, if a shop sells 100 chocolates at 10 each, then TR equals 10 times 100 equals 1,000. 2. Average revenue, AR, revenue earned per unit of product sold. Formula, AR equals TR quantity. Example, if TR equals 1,000 and 100 chocolates are sold, then AR equals 1,100 equals 1010, same as the price per unit. 3. Marginal revenue, MR, extra revenue earned by selling one more unit. Formula, MR equals change in TR, change in quantity. Example, if TR increases from 1,000 to 110 by selling one extra chocolate, then MR equals 110 minus 1,000, why 1 equals 10 plus t. Short trick to remember, TAM, T total revenue, average revenue, M marginal revenue. This will help you quickly recall the 3 types of revenue. Total revenue, TR, meaning total revenue is the total money a business earns by selling its products or services. Formula, T equals P times Q, where P equals price per unit, Q equals quantity sold, TR equals total revenue. Example, if a shop sells 100 chocolates at 10 each, then TR equals 10 times 100 equals 1,000. Short trick to remember, PQ, price quantity. Just remember PQ, as it directly gives you total revenue. Average revenue, AR, meaning average revenue is the revenue earned per unit of product sold. Formula, AR over TRQ, where TR equals total revenue, Q equals quantity sold, AR equals average revenue. Shortcut, since TR equals P is Q, dividing by Q gives A's P. So average revenue is the same as price per unit. Example, if a company sells 50 items and earns a total revenue of 5,000, then AR equals frac 5,050. This means the product was sold at 100 per unit. Short trick to remember, TRQ equals P. Just remember AR equals P store, because average revenue is simply the price per unit. Marginal revenue, MR, meaning marginal revenue is the extra revenue earned when one more unit of a product is sold. Formula, MR equals delta TR, where MR equals marginal revenue, delta TR equals change in total revenue, del Q, change in quantity sold. Example, a seller earns 2,000 from selling 200 units. After selling 201 units, total revenue becomes 2,200. So, MR equals 2,200. This means the extra unit added 200 to total revenue. Shortcut formula. MRN of n TRN n minus 1. This means MR at n units, TR at n minus 1 units. Task short trick to remember. MTC, more units total revenue changes. M marginal revenue shows how much T total revenue C changes with more units sold. Importance of revenue. Revenue is crucial for a business because it helps measure success, attract investors, build reserves, grow the company, and increase market share. Key points. 1. Revenue as a performance indicator. Revenue shows how well a company is doing. Financial reports show revenue, but not always if the money is received in cash. 2. Attracting and satisfying investors. Shareholders and investors expect good performance. If a business fails to meet targets, investors lose confidence and may withdraw support. 3. Building reserves for tough times. After the startup phase, companies save money to survive during economic crises. Instead of keeping money in banks, low returns, they invest in profitable assets. 4. Boosting business growth. Companies aim for higher sales every year, e.g., 7% this year, 9% next year. More sales equals more revenue, faster business growth. Familiar products, easier to attract new customers. 5. Increasing market share. Market share is like a pie. A bigger slice means more dominance. Higher market share, more revenue, and stronger business. A company with a good strategy beats competitors. Short trick to remember. PRGMS, Performance, Revenue, Growth, Market Strategy. This helps recall the importance of revenue. P, Performance Indicator. Reserves for crises. Growth acceleration, market share increase, strategic advantage over competitors. Explanation of revenue curves. A firm's revenue changes with output levels. Let's break it down. 1. Total revenue, TR, equals price, quantity sold. Initially, TR increases but at a diminishing rate. Once it reaches a maximum, it starts declining. Less competition, higher price, more profit. Example, if 10 units are sold at 100 each, TR equals 1,000. If 20 units are sold at 80 each, TR equals that 1,600. Average revenue AR curve, AR equals TR or quantity sold. The AR curve slopes downward as output increases. It also represents the firm's demand curve. Higher demand equals higher price. Example, if TR equals 1,600 for 20 units, then AR equals 80, 1,600 per 20. Marginal revenue MR curve. MR equals change in TR, change in quantity. MR decreases faster than AR. When MR equals 0, TR is at its maximum. If output exceeds this point, MR becomes negative. Example, if TR increases from 4,000 for 18 units to 4,029,000 for 20 units, the MR equals 29,000, not 39,000 per unit, because price reduces at higher output. Key observations from table and graph. As output increases, TR first rises, then flattens, and later falls. AR and MR curves slope downward, but MR falls twice as fast. When MR equals 0, TR is at max. When MR is negative, TR falls. Short trick to remember, TAM total average marginal. T total revenue first rises then falls. Average revenue slopes downward like demand curve. M marginal revenue falls faster than AR, can be negative. Significance of revenue curves. Revenue curves help businesses understand profits, production, and pricing. Here's why they are important. 1. Profit and loss estimation. Profit is maximized when AR/AC, average revenue, average cost. The bigger the gap between AR and AC, the higher the profit. Helps businesses check if they are making supernormal profit, high profit, normal profit, break even, losses when AC/AR. Example, if selling price per unit equals 50 and cost per unit equals 40, profit per unit equals 10. Finding equilibrium, MR equals MC. Equilibrium equals best production level for maximum profit. A firm produces until MR, marginal revenue, equals MC, marginal cost. This decides output, price, and profit loss in any market, competition, monopoly, etc. Example, if producing 10 units gives MR equals 200 and MC equals 180, increasing production may increase profit. But if MR/MC, production should stop. Hack 3. Capacity utilization tells if a firm is fully utilizing its resources. A firm operates at full capacity when the AR curve touches the AC curve at its lowest point. Perfect competition, full capacity used. Monopoly, imperfect competition, not always at full capacity. Example, if a factory can make 1,000 products daily but produces only 800, it's underutilizing capacity. Understanding price changes. ARNN and MR help in determining wages, rent, interest, and profit. MRP, marginal revenue productivity, and ARP, average revenue productivity, decide how much to pay for land, labor, and capital. Shapes pricing strategies in different markets, competition, monopoly, etc. Example, if workers increase production, businesses may pay them higher wages based on MRP. Short trick to remember, PECP, profit equilibrium capacity price. P profit estimation equals profit, equilibrium MR equals MC best production level. C capacity utilization ARTC at minimum equals full use. P rice changes, MRP and ARP decide factor pricing. Relationship between total, average, and marginal revenue. Revenue concepts help businesses decide pricing, sales volume, and profitability. Let's break it down in simple terms. 1. Understanding total, average, and marginal revenue. Equal price x quantity. Average revenue AR equals TR quantity. AR is the price per unit. Marginal revenue MR equals change in TR when selling one extra unit. Example, selling 1 unit at 20, TR equals 20, AR equals 20. Selling 2 units at 19 each, TR equals 38, AR equals 19. MR equals 38, 20 equals 18, revenue from selling the second unit. 2. Relationship between AR and MR curves. When AR equals MR, they overlap. MR decreases faster than AR because companies lower prices to sell more. MR becomes 0 or negative when TR stops growing. Example, if a business lowers prices, it can sell more units, but revenue per unit drops. When MR equals 0, TR is maximum, company should not produce more. If MR goes negative, producing more reduces total revenue. Graph explanation. TR curve increases first but later flattens or falls. AR curve slopes downward, price reduction needed to sell more. MR curve falls faster than AR and can go negative. 3. Quick calculation example. Given total revenue data, units, TR, AR, marbles faster than 1, 1, 10, 10, 10, 2, 18, 9, 8, 3, 24, 4, 28, 7, 7, 4, 5, 30, 6, 6, 2, 7, 28, 4 minus 2. MR equals 0 when TR is at its peak, 30 at 6 units. Negative MR minus 2 means TR is decreasing. Short trick to remember, TAM total average marginal. Total revenue, total earnings, TR equals P times Q. A average revenue, price per unit, AR equals TR over Q. M marginal revenue from selling 1 more unit, MR equals delta TR delta Q. Relation between cost and revenue curves. A producer wants maximum profit with minimum cost. This is called producer's equilibrium, where profits are highest and resources are best utilized. 1. Producer's behavior. 2 key factors. Maximization of production. Producer wants to produce more with limited resources. Limited resources. Money, material, and time are restricted, so decisions must be efficient. Profit formula. Profit equals total revenue, total cost, TC. 3 types of profits. 1. Extra normal profit, super profit, TRTC or ARAC. 2. Normal profit, TR equals TC or AR equals AC. 3. Loss subnormal profit, TRTC or ARAC. 3. 2 methods to find producer's equilibrium. A. Total revenue, total cost approach. A producer reaches equilibrium when the gap between TR and TC is maximum. Profit falls if production increases or decreases beyond this point. Graph explanation. TR curve starts from 0 and increases. TC curve starts above 0, fixed costs exist even at 0 output. The biggest gap between TR and TC is the profit maximizing point M. B. Marginal revenue. Marginal cost approach, OC rule. Equilibrium is reached when MR equals MC. If MR MC, produce more, profit increases. If MR MC, produce less, profit falls. If MC MR after MC equals MR ton, equilibrium is confirmed. Graph explanation. MC curve intersects MR curve at equilibrium. If MC rises beyond MR, profit stops increasing. Producing more reduces profit, so the firm should stop. Short trick to remember: PT, profit equilibrium, TRTC, profit, TR means TC, equilibrium, total revenue cost approach, TR and TC. Relation between short-run SR and long-run LR costs. 1. Understanding the cost curves. Short-run average cost, SAC curve, shows the cost for a fixed plant size. Long-run average cost curve envelopes all SAC curves and shows the lowest cost for any output level. Key point: in the short run, plant size is fixed. In the long run, the firm can choose the best plant size for minimum cost. Decision on plant size. A firm selects a plant size based on expected production. If producing Q0 sa, the smallest plant is best, cost 8. If producing Q2, the middle plant is best. If producing Q3, the largest plant is best. Key point: the firm adjusts plant size in the long run to keep costs minimum. 3. U-shaped long-run average cost, LAC curve. Economies of scale. Initially, larger plants reduce costs. Diseconomies of scale. At very high output, costs increase. Key point: LAC is always below or touching SAC curves, never above them. Marginal cost MC relationship. Short-run marginal cost, SMC, for a fixed plant size. Long-run marginal cost represents the most cost-efficient plant. Key point: LMC is not an envelope of SMC curves. Instead, it touches the lowest SAC at the most efficient output level. Short trick to remember: lens, LAC economies, number of plants, SAC, L long-run average cost, envelope SAS. Economies of scale, lower costs with bigger plants. A number of plants, choosing the best one for cost efficiency. Short-run average cost, different for each plant. Economies of scale in terms of cost function. 1. What are economies of scale? When a firm produces more output, its cost per unit decreases because of improved efficiency. This is called economies of scale. Key point: more production, lower cost per unit. Why do firms experience economies of scale? When a firm expands, increases production, it benefits from better resource utilization. Machines and labor work more efficiently. Bulk purchasing. Buying in large quantities reduces cost. Specialization. Workers become experts, increasing productivity. Key point: more production leads to cost-saving advantages. Types of economies of scale. There are 2 types of economies of scale. 1. Internal economies of scale. Cost reductions within the firm, better machines, skilled workers. 2. External economies of scale. Cost reductions due to industry growth, better suppliers, improved infrastructure. Key point: firms can save money both internally and externally. Short trick to remember: ICE, internal cost external, internal economies within the firm. C cost function, cost decreases as output increases. E external economies, industry-wide benefits. Internal economies of scale. 1. What are internal economies? When a firm expands its production, it experiences cost savings within the firm, called internal economies of scale. These reduce long-run average costs and improve efficiency. Key point: larger production, lower costs, higher efficiency. Types of internal economies. 1. Labor economies. Workers specialize in specific tasks, increasing efficiency and productivity. Example: in a car factory, one worker assembles doors, another paints. Both become experts in their tasks. 2. Technical economies. Cost savings due to advanced technology and better processes. Superior technology. Large firms use advanced machines, reducing cost. Linked processes. Firms manufacture their own inputs, backward integration, or sell directly, forward integration. Increased dimensions. Large firms handle all production steps in-house, saving time and money. Specialization. Tasks are divided among workers, increasing efficiency. Waste utilization. Large firms reuse waste to make byproducts. 3. Marketing economies. Large firms buy raw materials in bulk, cheaper rates, and reduce advertising costs per unit. Example: a big supermarket gets discounts for buying products in large quantities. 4. Managerial economies. Big firms hire specialized managers, finance, marketing, HR, leading to better decision-making and efficiency. Example: a small shop owner does everything alone, but a large company has experts in every department. 5. Financial economies. Large firms get loans at lower interest rates because of their strong market reputation. Example: a big company can borrow money more easily than a small startup. 6. Risk-bearing economies. Large firms spread risk by offering many products and selling in different markets. Example: if one product fails, the company still earns from other products. Short trick to remember. LTMFMR. Let's try making firms more rich. Labor economies. Specialization increases productivity. Technical economies. Better machines, linked processes, specialization. Marketing economies. Bulk buying, lower ad costs. Financial economies. Easy and cheap loans. Managerial economies. Expert managers improve efficiency. Risk-bearing economies. Diverse products reduce risk. One. What are external economies? When an entire industry grows, all firms within it benefit from cost reductions, called external economies of scale. These occur outside individual firms and lower the industry's overall costs. Key point: industry grows, all firms benefit, costs decrease. Types of external economies. 1. Economies of information. Firms in the same industry share knowledge about labor, technology, and research. Example: IT companies in Bangalore exchange ideas, leading to faster innovation. 2. Economies of concentration. When many firms set up in the same location, they all benefit from skilled labor availability, cheaper and easy loans, good transport and communication, reliable power supply, better marketing and sales. Automobile companies in Chennai benefit from nearby suppliers, skilled workers, and transport networks. 3. Economies of disintegration. Firms in an industrial area can outsource tasks or use each other's waste to save costs. Example: a steel plant's waste is used by a cement company to make a new product. Long-run average cost, LRAC, and economies of scale. Economies of scale, cost decreases as output increases. Constant returns to scale, cost remains the same with output change. Diseconomies of scale, cost increases as output increases. LRAC curve U-shaped. First, cost falls, economies of scale. Then, cost stabilizes, constant returns. Finally, cost rises, diseconomies of scale. Key point: firms aim to stay in the economies of scale phase to reduce costs. Short trick to remember: ICD, industry cost down. Information economies, shared industry knowledge. Concentration economies, skilled labor, finance, transport benefits. Disintegration economies, outsourcing and waste utilization. 4.5 Exercise 4.1 Short answer type questions. 1. State the meaning and concept of cost. 2. Discuss the accounting and economic cost. Explain in brief average cost and marginal cost. 4. Explain the cost function and cost curve. 5. What is the interrelationship between short-run and long-run cost curves? 6. What are short and long-run total costs? 7. Differentiate between cost control and cost reduction. 8. Explain the meaning and concepts of revenue. 9. Give the relationship between total, marginal, and average revenue. 4.52 Long answer type questions. 1. Describe the various types and determinants of costs. 2. Elaborate on the use of cost analysis in managerial decision-making. 3. Explain the cost-output relationship in short-run cost functions. 4. Describe the long-run cost functions in detail. 5. Discuss the interrelationship between average cost and marginal cost. 6. What is cost reduction and cost control? Discuss its techniques. 7. What is the revenue curve? Explain the significance of revenue and revenue curves. 8. Discuss the relation between cost and revenue curves. 9. Explain the relation between short-run and long-run costs. 10. In brief, enumerate the economies of scale in terms of the cost function. Task 4.53 Practical Questions. Run 1. Complete the table and also find out total cost. Output units, average cost, marginal cost, total cost. Total cost 2, 12, 16, 14, 5, 42, 4, 14, 18, 65, 16, 80, 6, 20, and 8. And total cost is calculated as TC equals previous TC's marginal cost for output 2, TC equals 2 and 12, 24. Minus for output 3, TC equals 24 plus 18, 42. For output 4, TC equals 40 to 18 equals 15 equals 60. For 5, TC equals 60 plus 20 equals 80. For output 6, TC equals 80 plus 28 equals 108. 2. Calculate TVC and TC from the cost schedule given below. Assume the FC as tens. Output units MC points. 1, 8, 2, 9, 3, 11, 4, 18. Output MC, TVC, TC. 1, 8, 8, 18, 2, 9, 17, 27, 4, 18, 46, 56. Total variable cost, TVC, equals sum of marginal cost, total cost, TC equals TVC plus fixed cost, FC equals 10. Calculate AVC and TC from the cost schedule given below. Output AFC, MC. 1, 120, 60, 2, 40, 30, 3, 30, 24, 4, 20, 35, 30, 28, 6, 35, 5, 30. Output AVC, TC, TFENGIN. 1, 32, 152, 2, 31, 182, 3, 30, 210, 4, 32, 245, 25, 6, 33.33, 320. Total cost, TC equal FC plus TVC. Average variable cost, AVC equals TVC. Output 4. From the following table, calculate total fixed cost, TFC, total variable cost, TVC, marginal cost, MC, AFC, and AVC. Units of output, total cost, 0, 90, 1, 120, 2, 140, 4, 210. And output, TFC, TVC, MC, AFC, AVC. 0, 90, 0, AVC. 190 by 30, 30. 90, 30, 2, 90, 50, 20, 45, 25, 3. 90, 120, 70, 30, 44. 950, 30, 22.5, 37.5. 5, 90, 220, 70, 18, 44. Total fixed cost, TFC. Total variable cost, TVC, TC, TFC. Marginal cost, MC, change in TC. Average fixed cost, AFC, TFC output. Average variable cost, AVC equals TVC. Output 5. Calculate marginal cost from the given schedule. Units of output. Average total cost, ATC, 8, 28, 12, 21, 16, 18, 25, 15, 30, 12. Output marginal cost, 8, 28, 12, 36, 16, 87, 25, 45. Formula used, MC equal change in TC, change in output. 6. The short-run cost function of an organization is C equals 190 plus 53Q, where C is total cost and Q is quantity of output. What is the fixed cost? If the organization produces 100 units, what is the average variable cost? I, what is its marginal cost? What is its average fixed cost function? Fixed cost FC equals 190 tau, constant term in equation. Average variable cost AVC equals 53 coefficient of Q. I marginal cost MC equals 53 threes since MC is the coefficient of Q in a linear equation. IV average fixed cost AQ.